In Australia, working a full-time job is no longer enough to buy a home, and this one chart proves it. Take a look. This line represents the average house price, and this one, the average full-time wage. See how they've diverged. For decades, they tracked each other pretty closely. But since the early 2000s, property prices have skyrocketed, leaving wages in the dust. Today, the average Australian home costs more than 10 times the average annual salary. It wasn't always this way. Your parents or grandparents might tell you stories of buying their first home in their 20s on a single income. That dream now feels like a distant fantasy for millions. Australia is one of the richest countries in the world, with a stable economy and abundant resources. So why can't so many of its own citizens afford a basic necessity like a house? It's a question that keeps a lot of people up at night. Young people are especially feeling the squeeze. They graduate from university, land good jobs, but still find themselves priced out of the market, stuck renting for years, sometimes well into their 30s and 40s. Many are giving up on the dream of homeownership altogether. This isn't just about owning a piece of land. It's about stability, about building a future, and for many, about starting a family. Let's put this in perspective. How does Australia compare to other similar countries? In the United States, the median home price is about 6 times the median household income. In Canada, it's a bit higher, but still generally lower than Australia's staggering multiples, especially in major cities like Sydney and Melbourne. For example, Sydney is consistently ranked as one of the least affordable cities for housing in the entire world, often beating out places like Hong Kong and Vancouver. What makes Australia so different? Why has the great Australian dream turned into a nightmare for so many? The problem isn't just one thing. It's a perfect storm of factors that have been brewing for over 2 decades. A big piece of the puzzle is supply and demand. For years, we simply haven't built enough homes to keep up with our growing population. This isn't just about immigration, which certainly plays a role, but also about the changing nature of our households. More people are living alone or in smaller family units, which means we need more individual dwellings. Restrictive zoning laws in our major cities have made it incredibly difficult and expensive to build new houses and apartments where people actually want to live. Developers face years of red tape and community opposition, which drives up costs and limits the supply of new housing. When you have more people chasing fewer homes, prices inevitably go up, but supply is only half the story. The other, arguably bigger, side is the massive amount of cheap credit that has flooded the market. Since the early 2000s, interest rates have been on a long-term downward trend, hitting record lows. This made borrowing money incredibly cheap. Banks were happy to lend out larger and larger sums, and people were eager to borrow to get into the property market. This created a feedback loop. Rising prices made people feel wealthier, so they borrowed more to buy property, which pushed prices up even further. It turned housing from a basic need into a speculative financial asset. A get-rich-quick scheme for those who got in early. Government policies have also poured fuel on the fire. Tax incentives like negative gearing and the capital gains tax discount have made property investment incredibly attractive. Negative gearing allows investors to deduct any losses on their investment properties from their taxable income. This means if the rent you collect doesn't cover your mortgage and other expenses, the government essentially subsidizes your loss. This encourages people to buy investment properties not for the rental income, but for the expected capital growth. It turns potential homes for first-time buyers into financial instruments for investors, who now own around a third of all rental properties in Australia. These policies have supercharged demand from investors, who often outbid young families and first-home buyers at auctions. This has created a deep sense of social frustration. There's a growing divide between the property haves and have-not. If you or your parents owned property before the boom, you've become phenomenally wealthy just by sitting on your assets. But if you're a young person or a new immigrant trying to get into the market now, it feels like the game is rigged against you. You save diligently, you cut back on expenses, yes. Even the avocado toast but the deposit you need just keeps getting bigger and bigger, always just out of reach. It creates a feeling of hopelessness. You do everything right too, study hard, you get a good job, you save your money, but the goalposts just keep moving. This isn't just an economic problem, it's a human story. I hear from people all the time. A young couple in their early 30s, both professionals who have been saving for a deposit for 8 years. They've watched as every home in their price range has been snapped up by investors or sold for hundreds of thousands over the asking price. They're now considering moving to a regional town, far from their jobs and family, just to have a chance. Or think about a single parent working 2 jobs who dreams of giving her kids the stability of their own home but knows she'll likely be renting for the rest of her life, subject to rising rents and the insecurity of short-term leases. These are the real-life consequences of our broken housing market. The flow-on effects are huge. People are delaying major life decisions like having children because they can't afford a family-sized home. Businesses are struggling to find workers in major cities because potential employees couldn't afford to live anywhere near the workplace. The long commutes are damaging our quality of life and the environment. And all that money tied up in mortgages is money that isn't being spent in other parts of the economy or invested in new businesses and innovation. It's a massive drag on our economic potential. We've essentially turned our homes into ATMs and our economy into a one-trick pony, dangerously reliant on ever-increasing property prices. So, what is the time bomb I mentioned at the start? It's the immense risk we've built into our financial system. Household debt in Australia is among the highest in the developed world. Most of this debt is tied up in mortgages. For a long time, this seemed manageable because interest rates were so low. But now, with rates rising sharply to combat inflation, millions of households are feeling the pain. People who borrowed to their absolute limit are now seeing their mortgage repayments explode, eating up a huge chunk of their income. This is the mortgage cliff everyone's been talking about. If enough people can't afford their repayments and are forced to sell, it could trigger a wave of defaults. This would put downward pressure on house prices. If prices start to fall significantly, it could create a negative feedback loop, the exact opposite of what we saw on the way up. Falling prices would make people feel poorer, so they'd spend less. This would hurt businesses and could lead to job losses, which would make it even harder for people to pay their mortgages, leading to more forced sales and further price falls. This is the nightmare scenario, a housing market crash that could tip the entire economy into a deep recession. The Reserve Bank of Australia is walking a tightrope, trying to control inflation without crashing the housing market, but it's an incredibly difficult balancing act. So, what's the solution? There's no single silver bullet. It will require a coordinated effort from all levels of government. First, we need to address the supply issue. This means reforming zoning laws to allow for more medium and high-density housing in our cities, especially along transport corridors. We need to streamline the approval process for new developments and invest in the infrastructure needed to support growing communities. Second, we need to re-examine the tax incentives that favor investors over owner-occupiers. Reforming negative gearing and capital gains tax would help level the playing field and cool speculative demand. Third, we could explore more innovative models of housing, like shared equity schemes, where the government or a private partner co-owns the property with the homebuyer, reducing the size of the deposit and mortgage they need. Some of these changes are politically difficult, no doubt. Any policy that might lead to a drop in house prices will be fiercely resisted by existing homeowners who make up a large portion of voters. But we can't keep kicking the can down the road. The current situation is unsustainable. It's creating a generation of renters, exacerbating inequality, imposing a major risk to our economic stability. The Australian dream of a fair go is fundamentally linked to the ability to secure a home. If we lose that, we lose a core part of our national identity. The conversation is difficult, but it's one we absolutely need to have. The time bomb is ticking. Thanks so much for watching. What are your thoughts on Australia's housing crisis? Have you been affected by it? Let me know in the comments below. And if you found this video insightful, please give it a thumbs up and subscribe for more deep dives into the big issues shaping our world. See you next time.